Hello, Jens. Good afternoon.
Hello, Theo.
How are you
So,
doing?
well, I'm doing good. It's getting hotter in here in Germany.
Yeah.
Finally, summer arrived.
Awesome, awesome. So, I think you can share your screen.
One sec. Let me. So there we go. Let me just probably type in a hello traders into the chat box. So this is where everyone can ask questions.
Yep. Awesome.
So Theo, are you a buyer now? Look at the dip in the Nasdaq and so on and so forth. Looks a little stretched to me.
Oh, yeah, yeah. Now, actually, I'm watching the 5 minute chart because I want to see some opportunities to scalp, to be honest, a little bit.
Nasdaq or FX?
Nasdaq, Nasdaq.
So if there's buyers, then it's you.
Look, there is a
If there's
compression.
any big size coming in, then we know okay, Theo
Yeah, that's for
is now
sure.
is now jumping in, stabilizing the market.
Yeah. I'm sure it's going to be a very valuable session, like all the sessions you do, but this one, important Forex economic indicators, something I think traders are very interested in what to watch, pay attention to, and
I hope so. I hope so. So it's more theoretically today. It's like we look at some economic indicators in this regard. We want to also have a look at the charts, but first of all, to make sure that we know why several indicators of higher interest than others, let's say. So
also,
I remember a very funny session one day when I was covering. I think that was when Euro USD was way hotter and more volatile, and then a client came and said, "Hey Jens, what do you think? How will today's Brazilian GDP affect Euro USD?" So
okay.
that was an interesting question because I think not really sure if Brazilian GDP is so relevant, but GDP in fact is. So that's
Yeah.
probably something to keep an eye on.
Also, I wish you good luck. I'll
Thank
talk
you.
to you soon.
Talk to you next week, Theo. See you. Bye
Thank
bye.
you. Thank you. Yes. Bye.
So, hello, and I welcome you to today's Trading Spotlight webinar. Together with Admirals, today we want to look at the four most important Forex economic indicators. Have a look at these, and yeah, I want to share some thoughts. First of all, as usual, we have to start with the risk disclaimer. We are talking about leveraged products. So these may not be suitable for all investors. So please make sure that you understand all risks involved when trading these products. Download a demo first at admiralmarkets.com. Yeah, well, get in touch with these products, see if your personal risk profile corresponds with these products. And if you finally decide, okay, well, I'm fine doing this and it corresponds with my risk profile, then you also have the chance to open a live account. Certainly, all details can be found on the website, also fully risk disclaimer. And if you have any questions, feel free to reach out to Admirals. In regards to Admirals, here there's some stats. Fully regulated broker licensed by the SISEC, FCA, SIAPC, JSC, ASIC, and so on and so forth. Very competitive offering when it comes to trading. Not just FX, which we want to focus on today, but also when trading indices, for example. And also, in addition to that, probably you know Admirals as a broker offering MT4 and the MT5 platform. I also recommend you to check out the Admirals mobile app, downloadable in every Play Store, let's say. So check it out. Very, very customizable first, but also very intuitive, let's say. So also definitely worth giving a deeper look. And but we want to focus today on the following agenda. Again, if you have any questions, please feel free to ask these questions in the chat box. If you are watching the recording now on YouTube, Don't forget to leave a thumb up here if you like what you will witness in the upcoming minutes. And also, if you have any questions, comments, please post them in the comment box. I'm not really sure whether this is the right wording for this, but below the video, I'd be more than happy to answer the questions. If I don't see them, then they will be forwarded from Admirals so that I can answer them. So feel free to comment and ask your questions if there may any. And so today's agenda, we want to focus on the 4 most important economic indicators. As I already said, it depends a lot on the overall picture, respectively, on the current mode in the market. You probably might be surprised to see here the 4th bullet point, the 4th it's inflation rate. So inflation has been a very, very hot topic recently over the course of the year 2023. Don't misunderstand this. I think they are all important, even though some are more important right now than others. So there has been a time, for example, I really well remember that was in 2013, 2014, and we will have a chart. I'm not really sure from when the chart is, but I can say there's been a time when employment numbers, especially the non-farm payrolls, created massive volatility in FX pairs, especially Euro USD, dollar JPY, also gold, also in equities, respectively equity indices like the DAX, Nasdaq, S&P 500, and the reason was that we had here a potential indication of when the Fed will start to taper. Back then, we had quantitative easing, and you probably remember that time. And then there was the question, when will they start reducing their quantitative easing, respectively? When will they start to probably also not just tighten their policy, but also start to think about rate hikes? And employment numbers were very important back then because they gave a very, very clear indication of where is the US economy standing right now. The stronger, the more resilient it is, the more likely it is that the Fed will continue to taper, respectively, be more restrictive in their overall monetary policy stance. That's why employment numbers were very important back then. Inflation, well, not really that much. Also, certainly the interest rate decisions, but also inflation now has been a very hot topic, while interest rate decisions have been very important with building the bridge towards inflation, because this is usually something which is mentioned over and over again in the press conferences. So it depends a little on the overall context, and it's very important to keep the context in mind. Also, watching here the videos on the Admirals channel, for example, follow also Paul, for example, and also Theo for thoughts on where do we stand right now, why is this and that event of importance. What we want to do today is we want to go through these, make sure that we all understand why they are important, and also certainly give an overall picture on where we stand. And by the way, in addition to that, I highly recommend here checking out the Admiral Markets Supreme add-on, the economic calendar. You probably remember the webinar we did, by the way. Okay. Let me just go over here to Admirals and the website, admiralmarkets.com. And I made this a topic already on Wednesday. Yeah, I've been here on Wednesday for the coverage of the market opening of US markets. And I was talking about the mini terminal, and I displayed this in my chart. You could see this there. And there was the MetaTrader Supreme Edition I mentioned back then. And when downloading this here to get this mini terminal, let me just scroll a little. So this is the mini terminal you are already familiar with. I have to just, by the way, see whether... No, it's not mentioned here. It's not, in fact. But you can see the economic calendar being found here. Where do we have it? Correlation matrix. Let me just see. Where is it? So you can see it's plenty of indicators you can get there. I can't find it. I can't see it right now. Where is the economic calendar? The news tab. Can't find it. So many indicators. Let me just see. Admirals market spread. Well, there, right at the top, right? Certainly, well, because of CA, well, calendar. So the calendar is also within this, and you can find it, by the way, here under or within the Supreme add-on. In this regard, it's not mentioned within here, but you will see at the end of the presentation how to display it in your chart and get these events. You can also customize it yourself and have it then displayed straight into your MetaTrader in this regard. So this is definitely a highly recommended add-on. I would say you should download. In addition to the mini terminal, you can get there to have a better trade tool in terms of the MetaTrader. And but now let's focus on the numbers here, or numbers respectively, the economic economic numbers. What's the word for this? Economic indicators themselves. And first of all, let's have a look here at the GDP growth rate. So GDP, what is it, and why is it noteworthy, respectively? Why should we keep an eye on it? Even though it's a very, like, how can I say that in a nice way? It's an indicator which is kind of, let's say, slow. It's not that surprising. You have to really see a big discrepancy here between what the market expects and where the numbers are published. So sometimes once the numbers are published, and by the way, it's published three times a quarter. In fact, why and what this means, I will go through this in a few seconds. But when you see the numbers being published, usually they are within a range and thus not that surprising. And then in addition to that, they are updated here with the first, with the second, and the third, or respectively final estimate here in terms of the GDP, respectively the growth rate, and that's making this indicator let's say, not such a volatile news event. That's probably a good way to put it. So I'm having it in mind, knowing that it all comes down to economic growth is certainly of interest. And by the way, you can also follow, for example, that's probably something of interest for us. Let me just here have Atlanta Fed GDP tracker. So there's several Feds. In this case, it's the Fed of Atlanta. In this case, it's GDP now. What they do is they take these economic indicators, and then they calculate for the current quarter, in this case, for the third quarter. And even though we don't right now have numbers, they were released at the end of July. First time. Second estimate will be seen then in around 1 week from now. Let me just check this out, by the way, or probably it's 2 weeks from now. Let me just here customize the Forex calendar. Let's only have a look here at the United States. And it's a high impact event. And then, by the way, we have to go here till the 31st. And then we'll see, do we have it here? No, we don't. Let me just see. It's probably it's not a high impact event right now, which is, by the way, underlining what I was just talking about in terms of the current trend. Yeah, there we go. And you can see it. There you can see it. That's the 30th of August. You can see second estimate, very important. So you usually have a first estimate. Numbers where came in at 4.1%. Is that true? Let me just check this out. Previous, it depends a little. Let me just have a look here. But I think they were quite strong numbers, if I'm not mistaken. So countries, United States, GDP growth rate, 2.4. Okay. They are not looking at the growth rate in this regard. So that's probably, it's the price index. I'm sorry. Let me just see. Here's the GDP growth rate. That's the number I was looking at. Sorry, that was the price rate. So 2%. That's the number from earlier, but the quarter earlier in this regard. It's not the first estimate. However, the thing is, you can already see it here. I had to bring this down to not the hot events, but in fact, it's here the medium impact events. And why is that displayed that way here? Because currently this is not a big topic. So GDP is not of interest. What's of interest? Probably let's go to the middle of September. Probably we can already display numbers up there. Let me just see. Yeah, there you can see, for example, PPI respectively here. You have inflation numbers, 6th of September. As you will see, this is currently a hot topic. That's why this is high impact, while the GDP itself is just like a medium impact event. That's how you can play with these. Not really sure whether you can make something out of a trading perspective from this, but it's kind of like a quick reminder on how to interpret these impact dots here. But now coming back to the GDP tracker, now you can see these are numbers for Q2, and these are second estimates. Now you might wonder, okay, here the GDP tracker from the Atlanta Fed, how come that they have already an idea or like an indication of, let's say, the GDP in Q3, and that's how they do it in this case. What they do is, in fact, they take the numbers which are coming in, like the retail sales, for example. They're also looking at the employment situation and so on and so forth, and then they have their own estimates based on these and build their own models. And here you can see they have a very positive outlook for Q3. You can see that it's right now rising beyond 5% up to 6% economic growth in the third quarter. Let's see if this really comes into play, because they adjusted over the quarter. But this is a nice way. Let me, by the way, share this probably in the chat box. It's a nice way to keep track of this. And let me just, where is it? There we go. So here's the chat. I call it GDP tracker. Okay, in the chat box, tracker. Here's the link. It's nice to keep an eye on this and see, okay, where do we stand right now? These developments here, for example, potentially have an impact on the next rate decision, because if you see economic growth picking up for whatever reason, and however, that might already give you a very strong not just a strong idea, but also it is a strong indication for economic growth. If numbers can then come in and disappoint, or this is what the market probably is expecting right now based on the numbers which are coming in from the Atlanta Fed and their economic projections here. Well, that could trigger some kind of volatility when the numbers are released at the last, or within the last week of October for the third quarter, than the first estimate. But now coming back, I try to make it not that theoretical, but still we have to have a look here at what is GDP, in fact. So now you have an idea on how to interpret the numbers and so on and so forth. Again, it's a not that, let's say, call it tradable indicator, economic indicator. Because it's very big. It's like a Titanic, if you want. It's not moving that fast. It's not kind of a speedboat. It's not changing that much. And you have three estimates, like at the end or at the beginning, the next quarter, at the end of the month. Then now at the end of the month of July, numbers were released, first estimate, and then second estimate. Then you have a third final estimate. Then new numbers come in, and usually they don't differ that much, especially within the biggest economy of the world, in this case the US especially. So economic growth is represented by the economic indicator called GDP, or it's short for gross domestic product. It's calculating the value of production for any country during a specific period of time, so quarterly, yearly. So you have numbers QOQ and you have YOY. Usually each country looks for bigger growth and increasing its GDP over time. So that's usually what the target is. Right now, there's some, let's call it headwinds, at least when looking in Germany, for example, looking at the overall industrial developments. Everyone can see that. Everyone could foresee that, let's say, with the developments, especially from an energy perspective. And that companies would shut down and probably go somewhere else where energy is cheaper. Where bureaucracy is not that high as it is right now in Germany. So there's some, it's like, it's no big surprise. And usually politics are after an increase in its GDP over time, because a higher GDP corresponds naturally with more people being employed. The more people are employed, the more companies are paying their employees, and the more business there's generated. Usually, the more prosperous the overall future outlook is, and the more likely it is that people will re-elect the politicians who are right now in power. So that's usually how the game is played. That's even more interesting now looking at Germany, when you just think that what they're currently doing just doesn't make any sense. The same is also true, by the way, for the US in this case, which makes it very, very interesting to see how the presidential election plays out there. But this is not today's topic. So usually, each country is looking for growth, respectively, an increase of its GDP over time. And usually, a rising GDP is considered a positive sign for the domestic currency. This is of interest for us as investors and traders, because if there's economic growth, well, this is usually then to investors saying, hey, this is interesting, I want to buy the currency, because if there's economic growth, there's a chance, and I already mentioned that more people are employed. You need more people to produce this and that good. Overall, all goods, and it's not just producing goods, but also services and so on and so forth. To get the best people, you have to pay them more interest or higher wages in this case, so they have more money to spend. So there is like an overall boom, let's call it. And usually, if you see these developments, well, then usually as an investor, you say, well, I want to profit from that. If you see strong economic growth, in this case, you could say that the stock of an economy is in fact its currency. So it's like you buy shares of this company, which is now the economy itself, and then investing in it. And once it has a interesting growth outlook, well, or a strong growth outlook, usually you want to profit from that, beside the fact that also inflation picks up. And inflation picks up means that the central bank will, to avoid an overheating of the overall economy, rise interest rates, which will also positively affect your investment, because now you're in a carry trade. You see capital inflows, which led the overall currency increase in its value. And in addition to that, you also have a positive carry, because you're getting paid interest for keeping the money in your pocket or your bank account, whatever. So, and as a result, you can see that here have to buy the domestic currency, which naturally results then in the value of the domestic currency to increase, and vice versa, naturally. So we don't need to go now through why is an overall negative economic outlook negative. Well, it should go without saying, if you see a drop in the GDP, 2 consecutive months of a negative GDP growth, for example, they are defined as the economy finding itself in a recession. Well, you don't want to invest in a country which finds itself in a recession. For what reason? Well, there's no growth. So it's more likely that the underlying central bank will cut rates. In terms of Germany, now it's the ECB. Will the ECB cut rates? That depends a little on their overall inflation outlook, because they say, well, we probably have to keep interest rates high to somehow get inflation back under control. The problem for the ECB in case of Germany is that Germany is, at least for now, still the biggest economy of the Eurozone, and it's the backbone of the Euro, which is the stock of the European Union and its economy, which means if you break the backbone of the Euro, Germany, killing the German economy by keeping rates too high for too long, and also have politicians in charge which are killing the overall industrial complex here with their ridiculous policy. Might be from an energy perspective, might be from a tax perspective, bureaucracy, and so on and so forth. Well, you're risking the euro as a whole, in fact. And that's definitely something which is worth watching, in fact, because the pressure could build here enormously. To be honest, if you follow me, respectively, in general, the developments here a little longer, then this does not come as a surprise. It was only a question of time once we get to see something like that. Because so far, and over the course of the last, let's say, 10, 15 years following the great financial crisis in 2008, we could say, well, as long as we don't find ourselves in a recession, everything's cool, especially since Germany is growing, profiting from a low euro in this case as a big export nation, and so on and so forth. The thing is, once Germany finds itself in a recession, which we find ourselves in right now, and I at least have the feeling that politicians don't really recognize this and don't see also and build the bridge towards the euro and the risks for the eurozone as a whole, with rising skepticism in terms of this currency, euro, in this regard. And what it's connected to, especially when looking at the poverty once you get older, for example, why it's so important to learn more about investing, probably more about active trading, to make sure that you can make ends meet, let's say, and get a yield for your hard-earned money. Instead of just, let's say, parking it in a savings account and getting like 0.1% or something, which has been done, and we kept rates too low for too long, also in the eurozone. That being said, well, to some extent, we had the impression of GDP growth, but overall, it was more kind of like a zombification to some extent of the overall economy. And this is exactly what's currently happening, because now we see bankruptcies all over the place, insolvencies of companies, especially here in the eurozone. The same was also true in the US. For example, you see some kind of fake GDP growth, but you don't, so nominal GDP growth if you want, but you don't really see true economic growth. Let's put it that way. But too many things here. We need to make sure that we also cover the other aspects. We already talked about the ECB, or no, interest rates to some extent. So first of all, GDP, but still, as you have seen already in the economic calendar, it's not that important, let's say, because it was already here brought down, let's say, in terms of its impact, because it's not a lagging indicator, but it's kind of an indicator, which is like, let's say, it's kind of the Titanic, let's say, and that's why it's not that important to closely watch. Respectively, it does not necessarily result in massive volatility in currency pairs. This is not true when it comes to interest rate decisions. They are usually of high importance. And it's not just that they're of high importance, but also that they trigger massive volatility. It's not just the decisions themselves in terms of, let's say, is there a rate hike now or something? But in addition to that, it's also the rhetoric being used in the press conferences, especially when the Fed speaks or the ECB speaks, especially the Fed. And the next event here will take place on the 20th of September. And the comments here towards where in which direction can really move markets. And it's not just FX related, but also gold, but also equity index related, NASDAQ, DAX, and so on and so forth. So interest rates themselves are important to understand, certainly when it comes to FX trading. So when it comes to interest rates, we speak about the potential yield an investor, respectively buyer of a currency, can expect to earn, respectively has to pay if he wants to borrow money, let's say from a bank. You probably have seen that within your accounts. Once you hold a position overnight, you get interest or you're charged interest. So it's so-called swap rates, which come into play here. And obviously, once you're playing, let's say, Euro USD, for example, from the long side, well, what does it mean if you're going long Euro USD for, let's say, several days? Well, it means that you borrow USD for 5% plus LIBOR and so on and so forth, but just to get the idea behind this. So you have you borrow a currency for 5-6%, and then you buy a currency like the euro, for example, and you only get 3%, which means there's a differential of -2%, and this is the amount you have to pay them. And the thing is, let me just check it out here. Okay. So The thing is now, interest rates obviously affect in this regard the moves of currency pairs in this regard. Usually, you will say if a central bank decides to increase its interest rate, hike rates during, let's say, significant economic growth or in the current environment, high inflation, to bring inflation back under control, well, then it should naturally result in higher demand on the local currency in order to get higher returns and vice versa. This is usually what you would think. When looking at the euro, for example, the opposite is true. So the thing is, for example, if you now hike interest rates too aggressively, while to some extent crushing the German economy in this regard, and it's not just the interest rates and hiking them, which affects the German economy to go down. But in addition to that, certainly it's also the increase in energy prices and certainly the importance of low energy prices for an industrial country like Germany. Well, then usually once you hike interest rates too high due to combating inflation, then usually you get trouble to some extent, and you can't overdo this. But if you do it, if you're too aggressive, then usually you drive the underlying economy into a recession. But what's probably of higher interest right now, and not talking about trends and giving an overall idea here, is how do, and probably you've asked a question that several times already in the past, how do central banks know what is the, let's say, fair yield level? So how come that they say 2% or 3% or whatever it might be, the interest rate? How come? How do they calculate this? And there's in fact a theoretical approach to this. It's called the Taylor rule, and I've snapshotted it here with this chart. It's from a website. It's Bantleon. Let me just see if I can see this. It's like, I think yes. So I found it via Google just to illustrate this. And it's, by the way, a very old chart, but one which perfectly illustrates this to some extent, I would say. So here you have the Eurozone in this case, the ECB, the interest rate level negative for some time, and then you can see the Taylor rule since 2015-16 it started to rise. It does not cover a COVID pandemic and so on and so forth. It's not included in here, but you can see that usually these two are positively correlated to each other. But then the in this case European debt crisis hit, and then these two started to diverge massively. And this is also something which perfectly illustrates what I mean if I say something like interest rates were kept for too low for too long. That's also something. And the Taylor rule, we don't go now through the formula itself, but you can Google it, by the way. We can Google it together. Taylor rule. So there you can see it. So here's the equation and so on and so forth. I'm not really sure if that really makes sense, but if you're interested, let me just see, by the way. So there we go. Now coming back to the presentation. So it's a good way to illustrate here and to understand where do yield interest rate levels come from and how do they decide within their parameters where and how to set interest rates levels when it comes to interest rate decisions. The next one, which will be of high interest certainly, will be the Fed on the 20th of September. So right now, there's also something, the Fed Watch tool, where you can find, let me just also Fed Watch tool, where you get an idea on what the market is expecting, which is very important, in fact. So it's a very important economic indicator. Certainly, makes sense. Fed Watch tool. And what moves markets, or what results in elevated what results in strong moves is once the expectation from market participants diverges from well, I don't need to change this. In fact, what happens once it diverges the decision from what the market is expecting? So that's certainly something to keep an eye on. And if you have, let's say, expectations being met, then keep a close eye on what's currently of importance for market participants, like elevated inflation, more restrictive monetary policy stance. Over the course of the year 2022, there were an aggressive rate hike cycle, which drove equity prices aggressively lower. If now the Fed somehow hints towards whatever words they might use, if it hints towards a looser monetary policy stance, rate cuts, let's say from the middle of 2024, let's say, I think Goldman Sachs just recently said that they're expecting the Fed to cut rates in 2024 from June onwards. I'm not really sure. Probably they already started then, because if you go here to June, you can see that the expectation here right now is 50% of market participants are expecting rates to be 50 basis points lower than right now, which implies there were already 25 basis point rate cuts till then. Probably the first one will be seen already in the first quarter, and here in March. But however, this is a very, very important tool here in this regard to get an idea on what's the market currently expecting in terms of interest rates. So then we have the unemployment situation and the non-farm payrolls to some extent. The release, which we cover usually live here with together with Admirals, the first Friday of each month. And I already mentioned it at the beginning. There was a time when this was a hot topic and market participants really were waiting for these events to happen. And in fact, you might probably wonder, saying, well, employment numbers, okay, but aren't they released each week? This is true. There's usually a release of the, we can see it here, initial jobless claims. They're usually, not just usually, but they are released at 1:30 p.m. GMT each Thursday. And they usually don't trigger any volatility. The reason for that is it's not because they're not important. They are, but they are released each week. So there's no big surprise on the upside, on the downside, because they are released each week. This is completely not true when it comes here to the non-farm payrolls, because the non-farm payrolls are released only once a month. And so there's a delay, and thus there's potential for a surprise on the upside, on the downside, and a divergence when it comes to the expectation from market participants. As I already pointed out, unemployment rate is important because it's the number which is released and showing you the number of unemployed people from the workforce in any country. It's an important indicator which should be interpreted very carefully, as it's one of the main drivers of economic growth and thus price movement in the underlying currency, because a rising unemployment, as pointed out here, potentially means that the economy slows down and vice versa. So the more people work, the higher the wages they are paid, well, the stronger the economy is expected to be to perform. While also the other way is true, that's saying, well, the more people are losing their jobs due to insolvencies, bankruptcies from companies, and so on and so forth, well, an economic is losing steam. That's usually the way you look at these numbers. And it's, again, as I pointed out already, one of the most important news releases. You should keep an eye on them, even though volatility dropped massively compared to what we've seen something like 10 years ago. When it comes to non-farm payrolls, usually they are published at the first Friday of each month. If not, no problem, because you will be aware of that since you are following Admirals here, and we are covering them each Friday, first Friday of the month, or second, whatever it might be, and give an overview on where do we stand here and what does it mean, how does it affect potentially the market. And again, it should be considered one of the most important economic indicators from Forex traders after the GDP and interest rate decisions, even though I think we should probably add some context here. It depends on the overall mode in which we find ourselves in. And there's a release here. I have it from TradingView. To just give an overview here on how massively the numbers have an impact on Euro USD. You can see here it spiked up to 120 around, and then was sold off to 119, and that's quite. In fact, it's a quite slow release, to be honest. So I've seen events with 200 pips trading range, and so then now the question is, okay, can we trade this? I wouldn't recommend doing this. In fact, I would say, well, it's you have to look at it from an overall context. Where do we stand? What's the market expecting? How do the numbers fit in? And then what I would say, and that's something I prefer to do also with earnings releases, for example, or from especially big tech companies. I look at the numbers and I know, okay, well, you have a high and you have a low. And then what you will say is, we say, well, most likely, once we break out of this range, so we're trading within this, if it's just a news release and there's no trend occurring, which is the case most of the time, then we say, well, we trade the break above or below the NFP candle here. Sometimes for a quick momentum play on the downside. In this regard, it was something like 10 pips here. Well, that's a bad example, but that's how I use these candles. So I know about the importance of them, that market participants are watching these and that it creates volatility. But from a trading perspective, what I want to see is having clear levels to trade off from, and that's how I use these. And so right now, probably the most important number right now, due to the current overall mode in the market, is inflation rate. So we covered this already several times in separate webinars, also here within the Trading Spotlight webinars here. So I'm not really sure if we really need to go through this slide, in fact. So we all know that inflation rate is a term used in order to express the rate of change in prices of goods and services in a country. In the following, here's an overview of how inflation rates, how you're confronted with inflation within the economic calendar. So CPI is the Consumer Price Index, published on a monthly basis, representing the rate of change in a basket of goods and services that are bought by consumers. It differs. So looking at the basket today is completely different than looking at the basket in the 1980s. And this is also a way to manipulate these numbers. So don't take them for granted. Don't think that this is really the true inflation rate. Go to the supermarket right now and buy whatever you want. You will see that the prices already increased massively. May it be, let's say, just I don't know, a beer or something like that. So I have to use beer as an example due to being German. But like, buy a beer. I remember a time 10 years ago when I was buying a very solid German beer, very good one, for something like 60 cents. Today it's 120, so it's 100% price increase, and has been has increased its price over time since Corona by another 20%. So you clearly see that this is definitely something to keep an eye on to get a somehow smoother inflation. From at least from an economic perspective, number here is looking at the core CPI, which is the same number, in fact, as the CPI, but it excludes volatile goods like food and energy, for example. And also important is the PPI, the Producer Price Index. It's the measures the rate of change in prices of inputs and outputs of goods at factory gates. Usually it directly affects the CPI, because the higher the prices a company faces once producing a good, usually it means a higher price at the end, which the consumer has to pay, even though you're not forewarning it 100%. And as I put it here in the last point, the interpretation of inflation depends mainly on the overall economic cycle. So right now, for example, I think we're in a stagflationary environment. Even though numbers don't really put towards this, but we have high inflation, we have low economic growth, even though numbers suggest something different, at least when looking at the GDP tracker. And that's why you really have to be careful about interpreting these numbers. Don't take them for granted. Sometimes it's also fake, similar to what you can find in the media. It always is about context and how to interpret these numbers, how to use them. This is why it's of importance for us. We know, okay, it's a hot topic, and right now, formulating a game plan usually will mean. Last year, it was like numbers come in hotter than expected. Usually that should result in prices dropping. If they come in hotter than expected and market is rising based on these numbers, that's probably a sign of strength, or that we're about to peak out to some extent in terms of inflation, and the other way around. So right now, we are not really reacting bullish for several months now, for a drop in inflation back to 3%, something like that. That's probably a sign that we're probably seeing some kind of like, let's say, short-term bounce from the recent drop lower due to commodity prices, for example, starting to rise again. When looking at WTI oil prices, for example, Western Intermediate here when it comes to oil. So it depends on the overall context, but it's definitely something very, very, very important. I went through this already at the beginning here with the MetaTrader Supreme edition. This is how the economic calendar looks in your chart, and why I highly recommending using it. So again, the numbers we were looking at were GDP, where the interest rate decisions, Fed, ECB, BOJ, Bank of England, BOE, probably the RBI, the Reserve Bank of Australia, and so on and so forth. You can all display them here. You can see also here as an example, jobless initial claims. Sometimes it makes sense probably to just say, I want to only highlight here the red dots, those of high importance, and keep out the noise and only be aware of that this event is now taking place and potentially affecting my FX trades. And that's it. Yeah, that's in fact it around this topic. So GDP, very important, even though right now it's very Titanic, like let's say it doesn't really move markets. Interest rate decisions certainly do. Employment numbers, non-farm payrolls do. Inflation rate does. And do I trade news live? Well, to some extent we do this live trading within the non-farm payrolls and they are being released. But as I already pointed out, usually I'm not the news trader who's just jumping in and hoping to catch a move on the upside or in the downside. But it's like I like to wait till the dust has settled. I don't really like to jump into the action, but then in these environments, I'm more kind of like, say, the analytical guy. That's probably a good way to put it. So I interpret the numbers, I look at what the market does out of them, and then I take position, for example, based on breaking above or below the call it news event candle. But this is usually something which takes some time and thus can't really be displayed within the webinar. So that's usually how I do it. And yeah, I just hoping that this answers the question. Again, so stock trading of importance certainly is, and also something which is of interest for many traders who want to start smaller. You have the chance of working with so-called fractional shares here. What this is, what this means. Check out the website from Admirals. Here are the contact details, and that's it. Yeah, that's it. That's it from my end for today. So if you just enjoyed this and probably watching the recording on YouTube, as I already pointed out at the beginning, feel free to leave a thumb up here, comment below here in the comment section, subscribe to the YouTube channel, set a reminder so that you don't miss any of the videos which we are producing here for you. And now it's now it's time to say have a nice weekend. Happy trading. Watch your stops. Talk to you again next week. I really look forward to it. See you. Bye-bye.